We're taking a longer-term view on gold today. Chart This is up next with Gary Wagner. Gary joins us now from Hawaii. Gary, thanks for being with us.
My pleasure. It has been a while. My pleasure as always to see you guys again.
Gary, the last time we touched base was before gold's correction in April. And I know we're going to be looking at a longer-term perspective for the metal today. Before we get to that, can I get your thoughts on what we're seeing on the gold landscape today?
You know, we've had some real pressure in the market. It was really characterized by having a $1,800 high and a $1,500 low pretty much through 2012. We were unable to take even 1,700 out on this last move up. And the key was when it broke through a critical area of around, we have it marked at 1520 and then at 1470. When it broke through that critical area, it really went into a free fall. And I believe that the two major components right now that are fueling lower gold prices are the higher prices in equity and a stronger US dollar. You've got institutional investors, hedge funds, and their responsibility to their investors are to obtain the greatest possible return. And so they're going to move money around into places in which they believe they can obtain the best results. As long as the equities markets are very, very strong, you will see money move out of safe haven investments such as gold and move them into the equities markets. And I think that's exactly what we have been seeing, especially the strong liquidation in the electronically traded funds, the SPDR and of course GLD. That, I believe, has been the strongest component to the downside pressure in gold.
Gary, gold has hit the psychological support level of 1,400, but is struggling to maintain it. Why do you think?
Well, on a technical basis, what we witnessed as the market came down and it first touched 1320, we did get a lot of buyers coming in, physical buyers coming in from Asia as well as India. However, every time it came up to around 1,400, it would stall, except for a couple of weeks ago when Ben Bernanke spoke. And when he spoke, we saw this huge knee-jerk reaction, and the knee-jerk reaction actually pushed the market to an intraday high of around 1412. And that was a number that many of us analysts were looking at on a closing basis, because we believed if we could get the market to move above that, we had an opportunity to see the market move higher. Now, in fact, last week on Thursday, we did see the market move above and close above that really psychological 14 and then 1412, but it was unable to sustain it, and we really saw the market come down and come down brutally on Friday of last week.
Gary, what support and resistance levels are you looking at?
Well, obviously, in terms of resistance on the upside, 1,400 and 1,412 are very big. We then have 1,450, but really the critical number, I believe, on the upside in terms of absolute resistance is 1,470. Because if you recall, when the market came down, tested 1320 and began to move back up, 1420 was really the significant, 1470 was really the significant number that it could not take out. That being said, once it failed there, it did come back down and came back down hard. Now, we did get a higher low and a higher high, just a higher low. And that, to me, is fairly significant.
Gary, but you also said we could hit those higher levels. When you speak higher, what is that number?
Again, if we can break 1,400, and that's a big if because we have not been able to take it out, but if we can, the real number I'm going to look for is going to be 1,470. That's really the mark we need to see taken out if there's to be any hope left for the bullish camp in gold.
Gary, that's a good point, but if I asked you if you're more on the bullish or bearish camp right now, what's your answer?
You know, you have to take facts as facts, and I am a gold bull, but I cannot be a gold bull right now. The downside pressure has been enormous. When we had that break, we have seen a significant decline in the price of gold just in the last couple of months. But as you'll see in the insert today, when we look at the big picture, although it is a brutal sell-off, it still falls within the confines of a potential run, a bullish run with a tremendously strong correction.
Gary, we'll get to your segment now, which will hopefully help shed some light for those folks out there who do feel that the sky is falling for gold.
On today's show, I wanted to simply look at a couple of facts, historically speaking, see if they lend any credence to looking for possible bottoms or ends to this tremendous correction. Take a look at this simple fib retracement that I have here. And this goes back, this is the year 2000. And we're starting at 416, that's the bottom of our fib retracement. We're taking it up to this top at 1100. And the only calculation, I've got three calculations, a 50% retracement, a 100% extension, which would be above this, and 123% extension above this. All of this information is derived simply from two data points, where the rally began, where the rally ended. And if we look at the correction that came following this rally, you can easily see that it lined up pretty much with a 50% retracement of this entire rally, takes you to about 758, and you've got lows here just below that, but as you can see, that's roughly the bottom. What I also find interesting is if we do some fib extensions, I did 100 and 123. Following rally that we saw, in which the marketplace, once again, here's that top at 1100, comes to 758. So now we've got our secondary rally. And this is the rally that took us to record highs right here. And the interesting thing is when we do our extension, 100% extension takes you to 1784. And 123% extension takes you to 1946. Realize this is a continuous contract of COMEX gold, so at that time you would have had gold trading higher than the spot price, which I believe was around 1920. But it's pretty interesting, or do we simply call it coincidence, that these numbers, meaning 100% move and 123%, the 123% being the absolute top of the next rally, and really the secondary point of resistance, and it was a major point because we had this triple top that could never get taken out. Isn't that interesting that that's precisely a 100% extension of this move to this move, 123, 100%. One other fib retracement can be found here. If we do fib retracement from the beginning of the rally, a 50% retracement, 1335. Again, on this particular rally, 50% retracement, 1758. Coincidence? Or is it possible that these numbers might be giving us some insight? There's obviously some good technical evidence that we could in fact be looking at this double bottom here. So the ultimate question is whether or not this bull market is over. Well, certainly the bull run that we've just had is over, has been over, and facts are facts. This is the run, and this is the correction. The fact that it lines up with a low of 1335, and that corresponds to a 50% correction, just like we saw in the last rally, gives us some technical evidence that if we're going to find a bottom, this is the point we really need to look at. Now, for those of you who would like to dive into this topic a little bit deeper, I do have additional bonus content available to Kitco viewers. You can get there from my front page, my website. That's, of course, thegoldforecast.com. Simply scroll down to the bottom and you'll see this little copyright right here. Just go ahead and click that. And if you're a regular viewer of Chart This, I do recommend that you bookmark the Kitco bonus content page. Again, Fibonacci retracement and how it lends insight into today's market volatility in gold.
Gary, thanks so much for that. We'll see you soon.
And I look forward to more interviews and hopefully shedding some insight into the precious metals markets in the weeks and months ahead.
And thanks for watching this edition of Chart This. We'll have more for you in the coming weeks. In the meantime, you can email us at newsfeedback@kitco.com or follow this conversation at Daniela Camboni. Thanks for watching.